So we've reached the official start time for our webinar. So welcome everybody who's joining us from wherever you're joining from around the world. Delighted to be your host today. My name's Helen Disney. I'm a director at the Realization Group, and we're going to be having a really interesting session today to talk about bridging the institutional divide between centralized and decentralized finance. This session is co-hosted by GMEX and AWS along with Luxoft. And we've got an excellent panel of industry experts here with us today to talk about digital transformation of the financial services industry, how we've gained accelerated traction over the last few years with the increasing adoption of blockchain solutions and digital assets. But nevertheless, as finance evolves and we move into what we're calling Finance 4.0, there's a growing demand to access and provide a full range of digital products and services alongside more traditional offerings. So we're really seeing the kind of convergence or development of a kind of hybrid finance between some of the centralized and decentralized solutions. What I'm going to do first of all to kick it off is ask Hiranda Misra, who's CEO and chairman of GMEX Group, to give us a few opening remarks, followed by some scene setting from Anup Nanra, who's global blockchain segment leader at AWS. So Hiranda, may I just turn it over to you? And I think if we have any speakers who haven't got their camera on already, if you could just switch your camera on as well, that would be great.
Great. Thank you, Helen. Hello, everybody. I think we're multi-time zone at the moment. I'm in Dubai and Anoop's in San Francisco Bay, and then everyone kind of in between. So, as Helen, you mentioned, there's a growing demand from institutional participants to get into digital assets. Obviously, there's the overarching element of regulation, jurisdiction to jurisdiction, and a lack of standards there, but things are evolving. Things are evolving fast, whether it's the US, Europe, Dubai, where I'm sat, and Asia. But the issue that really arises is, the traditional world and traditional platforms are so far removed from what's happening on the blockchain digital side. And also everyone speaks about blockchain and blockchain infrastructure or digital asset infrastructure as one thing, but there are multiple blockchains on the one hand, and then you've got traditional infrastructure that is very different technology on the other hand, with platforms on the post-trade side still running COBOL code and IBM mainframe, for example. So that in itself presents a challenge because, unintended consequence. There's more fragmentation now than there was ever before. So, the question being, there's lots of exchanges out there. There's lots of custodians, prime brokerage offerings on the digital asset side are emerging. But how do we join all that together? And how do we ensure that participants who are off-chain who don't necessarily want to be on chain yet or aren't ready get access to these asset classes?
Coming to you, Anoop, what are you seeing in the marketplace as this emerges? Obviously, you're a provider and you sort of see the bird's eye view, perhaps.
Yeah, it's a great question. And first of all, thanks, team, for having us talk about this topic today. I think it's very timely. One of the things that, to preface this, I'll go back a couple of years, right? 2014, 2015, we saw, and in the industry, we saw a lot of activity by classical institutions really trying to understand what the role of blockchain was in their business. And at the time, there was, I would categorize the participants at that time in one of two buckets, right? One was how do they respond to the blockchain innovation and the ecosystem that is rapidly growing out of fear of disintermediation, right? And so we saw a lot of broadly reactive behavior. But on the other hand, there were just as many and probably more institutions that realized that here's an opportunity to change the way that they operate and interact with their ecosystem, and how do they become and function as change agents for their industry. And fast forward, fast forward, a couple of years, we saw a lot of pilots, a lot of POCs. We saw some commercial launches of classical institutions launching businesses or exposing themselves to digital assets. We saw very early prototypes and I think even a commercial launch around private equities, right? And so, it was a safe use case to execute on. There wasn't really a lot of volume there. The complexity wasn't all that much. And so, it was a kind of low risk way to, jump into this space. Fast forward to about 2 years ago, and what we're seeing is, a kind of different perspective emerge. A lot of those early customers, a lot of those early, financial institutions who had been investing in blockchain technology and, getting the learnings and lessons learned under their belt are now asking, well, how do we launch a custody service? How do we launch a staking service and make that available to clients? And so, we're seeing all of a sudden, a shift from, I would say low risk, low reward, let's try to understand and educate ourselves about the use cases, to how do we now create and drive real market opportunity? And of course, through all of those conversations, and they're getting more and more sophisticated, these conversations over the last 2 years. And even as recent as, let's say, even 6 months ago, a lot of customers are asking about, well, what is that ecosystem that we should be thinking about, and how do we assemble that to go off and create those offers on, staking or custody solutions around digital assets? And so that evolution is happening. And one of the things that we're really excited about is it's kind of raised the level of the quality of the conversation across the ecosystem to really understand and expose that, this does take partnerships, right? This does take the willingness to drive interconnectivity. And of course, what we're seeing coming out of that are, things like what we're about to discuss a little bit later on today. So I think it's a very exciting time. There's definitely a new set of questions that are being asked that we'll talk about a little bit later on as well. But definitely the trend is here, and I believe it's here to stay.
I agree. I mean, I think it is really exciting, having been involved in the blockchain world myself for around 8 years. I think for a long time from the traditional finance side, it was why should we, and what is the reason why? And I think the technology has proved itself now, and it's more about how should we, how can we do this? How can we build these bridges? So I think we're going to come on to this a bit more in depth now with our panel. We have some speakers that I haven't yet introduced, so I'd like to just introduce our full panel. We've got Nicolas Steiner here, who's Director of Strategy and Innovation at Invesco. Arishi Goel, who's a data policy and blockchain specialist at the World Economic Forum. And we know there's a lot of policy and regulatory concerns around blockchain and how to implement this in the regulated industries. So I'm excited to hear from Arishi. And then we've also got Hugh Edwards here, who's MD of Products and Solutions at DXC Luxoft. So first of all, welcome and thank you to all our panel for being here. I'm going to kick off with a question to Nicolas and just ask, as we move more and more towards more assets being tokenized, how likely do you think it is that everything will eventually become decentralized? And where does the risk come in for the regulated entities, from your point of view?
Okay, so firstly, let me put some context, just by saying, this is a big question, but basically saying that at Invesco, we believe that tokens sitting on a blockchain represents the next generation of financial services. However, if it makes sense to assume that most assets will be tokenized, we are not sure that everything is going to be decentralized. And based on this, we are focusing on different models brought by this technology and how this model needs regulatory frameworks to be adapted. So the model, which is well understood internally, relates to tokens with, let's say, off-chain collateral, meaning having the underlying asset stored with an escrow, such as a bank. Best example of this is USDC. So this type of tokens are the kind of natural extension of the traditional finance we know. And they will coexist with more disruptive models, which are token with collateral sitting on the chain, meaning that the assets are locked on the blockchain itself with a life cycle managed by a smart contract. And this actually brings challenges for regulators, because the condition of what an entity will obtain when they sell, lock up, or borrow an asset is managed by the program in an ecosystem which cannot be controlled in a single state or a single entity. So basically, all this means that conceptually it can automate the job of many existing players in traditional finance, and there is room for improvement, basically. So with this in mind, let's say we believe that tokenized asset managed decentrally will become increasingly important, and they will live alongside centrally controlled assets, and it will likely bring in the long run a more transparent market and financial ecosystem. So back to your question, what I just described is a big challenge and is the fundamental behind some of the main risks we see for the future business of regulated entities active in traditional finance. And in this context, we are working at Invesco to define how can we position new activities as a regulated entity in a domain which is not regulated yet. And we are working toward how we can be positioned in the future of finance and anticipate business model changes. So I will just finish by saying that some of our investigation in progress look at how to get involved in the trading of these tokens by either be early stage investor in the next market infrastructure, or by tokenizing some of our assets on a blockchain to optimize the process and target the distribution of a product to different type of clients.
That's really interesting. And I guess, from a regulator's point of view, a lot of this comes down to taxonomy. How do we actually describe and define these different types of tokens? It was interesting that you mentioned USDC, a stable coin, as one of the first things you mentioned, because that in a way is a classic example of a hybrid solution. We have stable coins really because people in traditional finance and others concerned about the volatility of cryptocurrencies, and stable coins provides a kind of mechanism to bridge between the two worlds. But we're seeing a lot more kind of movement from the regulators. Obviously, we've had this big announcement in the US today about the executive order around regulation, greater regulation of digital assets, and I guess stablecoins will come into that. So I wanted to ask Arushi a question around that, which is, every jurisdiction is kind of acting a little bit differently. The EU does one thing, UK does something, US does something, Asia does something else. How can we get greater, I guess, global coordination of policymaking? This is something that really interests me because I used to work in the think tank world before I got involved in blockchain. So I'm excited to hear what you've got to say on that.
Sure. Thank you, Helen. Firstly, thank you for having me, and it's a pleasure to be here. Well, that's an interesting question, something that's very difficult to answer, I would say. The good thing is there is an increased understanding that this is a system that you cannot, regulate locally, and you do need a global coordinated approach. And the regulatory system has to be fairly simple, it has to be robust, and most importantly, it has to be agile. But how do we really reach a very global coordinated system? I think the first thing has to be just an understanding of why we want to regulate it. Is it because we're looking at consumer protection? Is it because we're looking at market stability? Is it because we're promoting innovation? Or is it a combination of all three? So every jurisdiction could have very different reasons for regulating a crypto ecosystem or a DeFi ecosystem for that matter. The second, as Helen, you also mentioned, just the very basic uniformity in classification and taxonomy in standards. At least we all should be speaking the same language. FATF says NFTs are collectibles. If they're investments, well, they're not NFTs, but are NFTs investments as well? So we are just not speaking the same language, and that's a big issue. The third thing is, I think we're still not leveraging technology as a regulatory mechanism. It's a great technology. It should form a part of our embedded regulation mechanism, but that's not happening. It will allow automated compliance. We have firms that are doing it, but for it to formalize in a better way, I think that's still an ongoing process. And just given the pace of innovation, I believe the fact it has to be a collaborative effort to reach a really global coordinated approach The public sector cannot do it by itself. The private sector cannot do it by itself. It has to be something where everyone collaborates to kind of deal with this challenge altogether.
And what about the data gaps? Because obviously there's quite a few data gaps when it comes to cryptocurrency. So how does that sort of impede policymakers' ability to do projections and modeling and kind of help inform policymaking?
Right. That's, again, very relevant, actually, because data is very important for any policy making, right? How else do we know whether something has an environmental impact and what's the degree of that impact, or a social impact, or an economic impact? So in that sense, we do need data to understand the impact of this ecosystem. Now, there were various challenges, I think, that are coming up in terms of data. We definitely do not have enough data. Yes, these are public blockchains. It's very easy for anyone to just go and access it and look at the record, but not all the transactions are happening on chain. With tokenization, or when systems starts connecting with each other, traditional financial systems connecting with public blockchains, not everything is going to happen on chain. It's simply not feasible, I suppose. And because of that, and because there's one section of your ecosystem that has no reporting requirements, so that data simply does not get captured. Again, the other bit is data flows, right? For traditional financial systems, for example, a traditional payment service provider, they would have to comply with certain data localization requirements or restrictions on where they can transfer their data, because financial data is to a large extent considered sensitive data. So when a decentralized system or a crypto ecosystem interacts with this traditional system, that data will remain within a particular jurisdiction. It cannot travel, which means the data is not available for analysis or aggregation to other countries. And finally, we do see resources where a lot of this data gets captured, it gets aggregated, it gets analyzed. But again, there's a lack of clarity on how that data is captured, what are the standards, what are the methodologies, because of which it becomes very difficult to set a benchmark. And then again, some of these platforms are fairly centralized, that do the data capturing, that do data service provisioning. And there are issues of conflict of interest as well. So just to shortly answer your question, it's a very challenging issue. And I think, again, it's a mix of tech and policy and the evolution in it, which will finally emerge.
I think one of the hardest challenges is that tech and policy are actually blending. Tech is becoming policy. In the decentralized world, governance is actually largely by code. And so how can policymakers sort of insert themselves into that process? It's quite a challenge, especially if there's not enough technical expertise, amongst the policymaking community. I think that's changing, but it's taken some time. Wanted to come to Hiranda on the issue of FATF, which Arishi briefly touched upon. Obviously, we've got institutions now coming into DeFi, which maybe was more of a retail activity in the beginning, but how do the challenges around FATF affect decentralized finance? I think you're on mute, Hiranda.
Someone had to do that. Trying to avoid background noise.
We've won the you're on mute bingo.
No, that's right. I'm lucky today, or unlucky. So with FATF now, it's really interesting. I mean, with Financial Action Task Force guidelines, I mean, initially there was concern about know your client and cross-border transactions, and so now virtual asset service providers, in addition to financial institutions, have been included in that, so that broadly transactions kind of in excess of $1,000 have to have that kind of requisite information and be shared. And so that helps Arushi from a data perspective, I guess. But the challenge that you have, as you rightly said, Helen, is, I mean, in terms of decentralized finance, you've got non-custodial wallets, and you've effectively got smart contracts that are administering the activity around those. Now, there's an argument from the decentralized side that obviously there are no single counterparties. Regulators in different jurisdictions are countering that to say, well, actually, even if they're decentralized, there'll be developers or there'll be some governance structure where you can point that to kind of some kind of single entity or set of entities or individuals. Recently as well, even on decentralized exchanges, given SEC rules and definitions had come into force kind of pre-decentralized finance, they've also been amended to reflect, beyond matching platforms, what constitutes a form of exchange, to bring in smart contracts. So the thing is, but the big challenge there is, let's say I'm not saying that Nicholas is looking at that or doing it at Invesco, but let's take the buy side, for example. I mean, they might be keen looking at some of the potential yield opportunities, given the fund management side that DeFi affords or lends itself to, which is really, really attractive. But the thing is, at the moment, being regulated entities, it's very difficult for them to interact with that because they need to know what's on the other side of it and what they're interacting with. So, what does that mean for DeFi? I mean, it's a word that I kind of introduced, which some decentralized purists will kind of, twitch in horror about, is regulated DeFi. Ultimately, there's got to be non-regulated pools, and that's great because there's lots and lots of small transactions, mom and pop, but at the same time, institutions who need to look at how they interact with certain, not necessarily, certain counterparties per se, but to be able to validate that what they're interacting with is bona fide and legitimate. So you're beginning to see institutional DeFi pools emerge in tandem with kind of retail pools. And those institutional pools are certainly attractive to institutions who are looking at it. A couple of years ago, they were struggling to get their head around tokenization and security tokens. Now they're getting very, very excited about what this could mean in terms of yield, other forms of product structuring, as Nicholas mentioned, how they can interact and integrate with, let's say, new markets that are digital with new users and wallet integrations, and at the same time try and solve, the issue on the post trade, which we'll obviously speak about later.
Yeah, I mean, I think regulated DeFi is already starting to happen to some extent. I think Swarm Markets defines itself as the first or one of the first regulated DeFi platforms. I'm sure there's others who probably make a similar claim. And obviously the issue of deeper liquidity could be, potentially interesting for decentralized exchanges as well if they start to really pick up traction. I wanted to bring Hugh in now to talk a bit more about the purpose of blockchain in all of this. We've talked quite a bit about different types of digital assets, but how can blockchain play into this in terms of reducing friction when it comes to linking up different networks? Because we've got multiple different blockchains doing different things. Obviously, there's a Bitcoin blockchain, which is for cryptocurrency, but other blockchains that are focused on DeFi. We've got enterprise blockchains. So how do we kind of prevent silos and prevent us from sort of replicating the silos we might have in the centralized world, in the decentralized world?
Yeah, good day, everybody. I think it's very important that we take a step back to answer that question, right? When we take a look at perhaps tokenization versus blockchaining, if we go back 5 years, right? I think we as an industry have done 5 key things, maybe not in the right order, but we've been working at them. Taking a look at big data, taking a look at the existing data patterns that we have between the existing ecosystem, and here I'm talking about traditional ecosystem of trading, all the big actors, and just taking a look at all the movements are, the key pieces of information we're managing, how we transact, the workflow across trading to settlement, just around the existing actors, let alone the global sort of regional aspects of it. And by getting a good handle on big data, we then take a look at machine learning and AI to determine the way to calibrate and to identify optimizations, for better trading, settlement, and risk management, and all the different areas that can come from that type of optimization. Then take a look, and many of us were involved in various fits and spurts around early blockchain, going back to 2017 and onwards, maybe even 15, 16, 17, and all the failed, but nonetheless necessary proof of concepts to identify how things could be optimized, recognizing that blockchain is a fantastic way of representing networks and actually not having to have differing databases that then ultimately need to be reconciled, right? So removing that entire burden. So it's an optimization tool first before digital trading. Then cloudification, leveraging complex demand compute infrastructure and migrating that to the cloud, and then cybersecurity reinforcement, bridging the new gaps as transitions going on. So those 5 key items are the larger pattern of what's going on right now to actually move banks, financial institutions, the market as a whole to a more optimized state. And at the center of that is blockchain from a point of view of optimizing. And I would just suggest that the industry, we've done things a little bit ass backwards in some cases, that we first tried to optimize big data, find new ways of making money off of that, doing fits and spurts blockchain, then optimizing. But if you take it in a different area and take a step back, take the pressure off, taking a look at what the network looks like, what the ecosystem looks like, and what that could look like over on the other side of this big gulf, which is a digital plateau. Digital trading is absolutely part of that. And I think these 5 steps have actually been really key to being able to optimize cost reduction that banks and financial institutions are under right now. And that's one of the big pushes that they're driving, while all these silos of different uses of blockchain are coming up. So if I'm a COO of a large organization, I'd be wondering, great, how can I meet my needs now and at the same time adopt the new hybrid world that is coming? Another area is simplifying adoptions of new technology, accelerating digital trading and settlement networks and taking advantage of that. And also, once we're on the other side of the gulf, optimizing cybersecurity ahead of quantum computing, which is not that far around the corner. But by centralizing, we get ourselves into a nice position to be able to optimize security on that front. So those 4 goals, based on those 5 steps, is what's really going on. Now, specific to connecting up the networks, a hybrid settlement solution is absolutely key to adopting digital trading. And I think that's why we're probably here today and discussing that. But decentralization is coming at the same time as all the pressures of optimizing. So again, if I'm a COO, I'm going to be a bit sort of distracted as well. How do I meet my cost optimization goals now, at the same time, do all these shifts? Because I know that in 5-10 years time, everything's going to be digital. And so I observed your question as you teed up the question, Helen. All these different silos, I think, are a means to an end, right? The tokens that we're looking to put into place for trading, and for that matter, as was mentioned earlier by Nicholas, around digital collateralization, we have to go through all of that. And I think it's necessary that we actually have these multiplicity of different endeavors going on, because the ecosystem that we're trying to replicate right now is complex. It's not just a matter of trading, settlement, and financing and depositing. You're taking a look at trade financing and all of the different levels that actually incur that. From an international point of view, there's a lot of players and a lot of actors, and blockchain will actually help optimize those. But again, come back fundamentally, it's a difference between tokenization and blockchain. I think there's uses for both, and they're actually both very much a key part of us actually making that transition. I hope I've addressed the question.
Yeah, and I very much agree with your distinction. Hiranda, I know you already started to touch on this a little bit, but let's say we move into this world where some of these bridges are kind of open and some of this interoperability gets solved. How do you see those new forms of distribution as enabling new types of customers and new types of product innovation? What do you think we will see when we get to the sort of fully Web3 world?
Yeah, actually, I mean, and even Web3, there's debates on different people think Web3's different, in terms of whatever views that you take. But actually, essentially, I draw an analogy because everyone on the decentralized side, or what I call the neo side, given my like of the Matrix, I mean, they talk about kind of all things going decentralized. But if you look at now, first there was posts, then there was email, and now there's instant messaging, and now we're heading towards information overload, right? In terms of both push and pull. But actually, all those forms exist. I mean, things may be in different buckets in proportion, but the banks, financial institutions, if you look at the buy side, they've invested hundreds of millions, if not billions of dollars in terms of infrastructure. That isn't going to go away overnight, and there's debate around how that will evolve, as Hugh said, and others. But at the same time, about a year ago, if you spoke to most financial institutions, tier 1, tier 2 banks, asset managers, they would have said, it's all going to be private blockchains. Now, most of them that have really started to look at this and lift the hood have concluded that it's going to be a mixture of public and private blockchains. But coupled with that, there's got to be a level of integration into traditional infrastructure. So, there's well-versed protocols like FIX for trading, the Swift MQ on the post-trade side. Yes, of course, on the Neo side, and as well as traditional REST APIs and things like that in terms of technology are there. But the API approach, just given the way payments work, given the way clearing and settlement works, and given some of these systems isn't going away anytime soon. So, recently we launched something technologically that offered what I call kind of atomic settlement. But at the same time, we got asked by one client whether we could slow it down to T+2. Because the systems upstream just couldn't handle it. So what you're going to see now, very much what you said at the start, is hybrid market infrastructure. So, is DeFi the answer? Certainly for some people it is. For others, they will evolve to that, whether it's regulated or not. Traditional finance or TradFi, certainly. As Arushi said, certain things are on-chain and off-chain. A lot of the exchanges that have the digital asset volume are CeFi platforms, so centralized finance platforms. But you're going to see all those intermingle and interconnect. And now, whether you're doing that with some form of layer 2 protocol, where everyone's or you're doing that via layer 1s for settlement, or you're doing that API driven into traditional infrastructure, it shouldn't really matter. You should be able to do it the way that you want to do it. You don't necessarily have to run a blockchain to actually have access to digital assets. So, for example, you could choose to, it's interesting, it's in the public domain. If you look at what Nicola has done with Invesco, recently they announced the creation of Bitcoin exchange traded products. Very, very interesting products. But actually the underlying custody, one such example was at Zodia, where that Bitcoin was custodied. The wrapper and the product was then created. And based on that product was then listed on traditional exchanges like Zitra and SIX. Not digital exchanges, even though, as Nicola said, there's an opportunity there. So actually, why shouldn't you be able to do both? Actually, as you move forward, a multi-custody model makes sense because you don't want single custody risk, much like we have multiple bank accounts, again, or you have assets at multiple custodians traditionally. You'll want to use a combination of neo custodians and traditional ones. So the fact of the matter is there needs to be choice. It doesn't matter if you're on Vodafone or I'm on another network, 3, we can still talk to each other. We don't really care how we're talking to each other. I'm sat in Dubai, you're in London, and we still are. And that's where we're going to head to here.
Well, I think it shows the maturation of the market in a way that so many different choices are available with varying degrees of centralization and decentralization, and wrapping different products in different ways, as you said. And your example actually reminded me of a analogy I think you gave to me before, which is this is really difficult to do. So it's almost like the traditional institutions are going along a road at high speed and they're kind of trying to change the tires on the car at the same time, and that's quite difficult to do. You're still operating in a regulated world with all of the constraints that entails. You did also mention APIs, which I think is interesting because to some extent for some of the traditional institutions maybe it's not so much at the moment still about decentralization, but more about digitization. So I wanted to ask Anoop about that and the need for APIs and getting rid of some of the old legacy systems, because in some senses, the impact of fintech and then, blockchain and digital assets as part of that has just been simply to push banks and other financial institutions to digitize and modernize what they do.
It's a really interesting talking point, and coming from the AWS vantage point, everything here is done by APIs, right? A number of years ago, Jeff Bezos, basically issued a decree, a top-down decree that everything will be driven by APIs, and from that we've seen the evolution of Amazon into what it is today. And so I do think that modernization of infrastructure is really critical. And so as Hugh rightly pointed out, right? Blockchain is just it's just a tool, right? It's a tool that needs to be considered as part of a digitization or modernization strategy that is being executed with a I would say a top-down mandate. This is a space that changes the way people think, how they operate, how they interact with each other, right? So, and that's not just focused on blockchain. I mean, just the whole notion of digitization, automation, optimization is really critical to understand, and to really important to weigh the cost benefit analysis of what can you deliver today versus what you should be delivering the next day, or in the next sprint, if you will. And so that kind of mindset shift really needs to be ingrained. And then as we look at how the space is evolving from a digital transformation journey perspective, yes, APIs are going to be really, really important, but also the notion of how do you secure this in a robust, dynamic, forever learning way is also something that needs to go hand in hand with the digital transformation journey. I've been doing security on and off for many years, in and out throughout my career, and historically security has been thought of as an afterthought, right? I mean, you build your product, you ship it, oh, then we got to secure it, right? The same can be said in certain industries about services. Well, we build a service, we get customers who consume that service. We can monetize that service now. Oh, we need to now improve our security around that. I think one of the things that blockchain has shown us is that we need to be thinking about security from day one, right? So security is part of your day one strategy on how you drive your digital transformation journey, which may or may not include blockchain technology. But let's say it does, you now end up with potentially a far more robust ecosystem, right? So it's not just about your product or your service set, it's how you govern the interactivity between yourselves, your counterparties, and external stakeholders, even internal stakeholders, I would say. So security is super, super important. And I think we're at that point from my comments earlier on the trends that we're starting to see, where customers, financial institutions are now starting to understand. They understand what blockchain can do and what it doesn't do, right? So they've got that 5, 6 years, 7 years worth of education, and now they're trying to build products and services, and they're now starting to realize, oh, we need better security models around this as well. And again, all API driven. It has to be. Just for velocity, time to market, velocity of money. I mean, these things matter. And so as we think about this, I'm still waiting for the day when the first financial institution, turns around and says, we are going to be putting 20% of assets under management on Ledger. I don't think we're there yet. I think we still have a lot of work to do. But fast forward even from that, if you take a look at the language that is used in the DeFi space, when does assets under management become synonymous with total value locked, right? These are two big metrics in this industry. It's all financial capital markets industry. But I would say one is very classical institution oriented, and the other one is DeFi oriented. But are they the same metrics? Could they be the same metrics? And if so, how do we get there? Right. And I think that's the path that we need to define. And it requires automation of threat identification, automation of response to those threats. How do you automate investigations? How do you continually apply and comply with OFAC or FATF requirements, right? Not as an afterthought or as a result of an event, but continuously in learning, right? I think these are the challenges that are going to start surfacing in the next few years, and we have to be prepared for that.
Yeah, and I think it's interesting how the kind of institutional custody market is evolving to address that challenge, because really it's those crypto custodians that will need to provide solutions potentially to some of those regulatory challenges, finding ways for people to be able to check transactions to make sure they're not dealing with suspicious addresses and avoid manipulation of smart contracts and all those kind of things. So, we've got a lot to see, I think, from the institutional custodians and how they address that and encourage more institutions in. I mean, we've already seen, obviously, in the last 2 years, a massive increase in DeFi. I think we're up to around $200 billion locked in DeFi now, but that's probably still the tip of the iceberg of what we'll see if the institutions really seriously start to come in. So there's quite a lot of work to be done there, I think. And I love your comment about the changing mindset, because I think that's the way I've often described blockchain. Is it's not just a technology; it is a different way of seeing the world. And I've had a company say to me once, we explored doing a blockchain project. In the end, we didn't end up using blockchain, but the fact that blockchain existed meant that we approached the whole project conceptually in a completely different way, just because we knew we could do multi-party things. We could go outside of our centralized way of thinking, and that changed the entire way that we conceptualized the project. So I think that is something else that's starting to shift. The APIs as building blocks, obviously that's one of the fundamentals. I guess the other one, or one of the other ones, is digital identity, because if we're going to have the need for KYC and AML requirements with regulated institutions, we need digital identity. So Hiranda, how do you think that issue affects the speed at which kind of CeFi and DeFi can converge?
Actually, a lot of things are made about, or issues are made about, KYC, ML, but ultimately, we're not reinventing the wheel here. We kind of often say this even on the fiat leg of transactions. When you interact with the banks, who are some of which are reticent to touch it. But there's, again, with most KYC ML systems to a large degree are centralized ones. Whether you're looking at blacklists or PEPs, etc. But in terms of what we do, we've been integrating those quite aptly, and those validation and API calls are real time as part of the process of onboarding, and then ongoing validation. Also now, certain institutions that are reticent to kind of move assets continually on chain can have those, as you said, sat with custodians, but have those reflected as credit upstream and utilized across a broad range of venues and participants as well. So some of the things we're working on address that area and the many to many, and KYC AML is integral to that process, because when you're doing B2B, you can't really ignore it. Equally, some other areas, like unfortunately, Hervé couldn't make it here, but Pictor, which is under ING Labs, I mean, they've got this. It's not to say that all of this is centralized. They've got a module for FATF R16 compliance called Pixis that actually is a distributed module, that's open source, that allows kind of FATF compliance and AML validation. Again, that's layer 2 blockchain driven as well. So you're seeing a combination of both centralized and decentralized solutions emerge. And it's all about integration, because you might want to use something for KYC and checking lists, something else for coin forensics, and it's all about integrating that in a seamless way. The other thing that people forget, related to that, and it's an interesting point on data, is smart contracts are only as good as the data that feeds them, and a lot of that data does, as Arushi said, reside on the centralized side. So you're also seeing the need for centralized oracles that validate that data. There's data lakes that AWS have done a lot of work on as well, but have that data in meaningful form, whether that's KYC, ML data, or other forms of data, and to be able to feed those smart contracts. Otherwise, it's garbage in, garbage out, right? So interesting developments there.
Yeah, that's a really good point. I think, coming back to the custodian issue, we mentioned already that, perhaps in traditional finance, one custodian is enough and perhaps desirable, but in DeFi you may need, to access different types of custodians. I wanted to turn to Nicolau and just ask a bit about what the use cases are for hybrid finance and how you think that technology can enable those.
Okay, so, as hybrid finance refers to what will be the bridge between traditional finance and DeFi, then yes, it's going to be technology driven, and it's going to be at the core of what we do. We say, generally speaking, it is key for Invesco to, let's say, understand the opportunity to leverage our existing business, and our goal is to build, actually to build, to partner or invest in the key components, bridging what we do with this parallel universe, which is a crypto world evolving at speed. So to, let's say, to provide some context again, before moving into the custodian piece, and based on what has been mentioned earlier, so let me add that our thinking is mainly based on the use case evolution of the stakeholder position in the digital value chain. And in a way, it will evolve from, let's say, currently being a provider of content consumed as a product by social network and others, up to what it will look like tomorrow with Web3 application going to be potentially driven by decentralized communities. So we are looking at the common digital fundamental behind the evolution of the web, and our focus is related to service managing the digital life cycle of any authenticated business or person to be compliant in the way they are digitally active in financial services. And in this context, in a tokenized economy, the custodian function, which is mainly evolving to the management of keys, providing access to the asset on a blockchain, is likely becoming a, let's say, key element of the future ecosystem supporting token economic use cases. So I would add to this that the challenge for us in traditional finance is to make sure that this change is well understood at strategic level. So we spent a lot of effort to communicate internally, that this evolving function, the evolving function from a traditional custodians to a digital custodian for token economic use case, to say that this is potentially one of the main bridge between the traditional institutional market and the cryptocurrencies and DeFi world. And I will just finish by adding that up to now, the crypto product launched by traditional finance has been mainly focused on blockchain and Ethereum, and Bitcoin product was mentioned earlier. So it's kind of easy to imagine the necessity in the future to have a custodian solution providing support for growing numbers of tokens and investment services.
Yeah, and I think potentially we'll also see a lot of kind of, consolidation of the custodial market, because obviously it's such a key role. You're going to need, it is literally a key role. They're managing your keys, but you need trust. And so the larger they are, the greater insurance they have, the deeper kind of pockets they have, the more robust they will be and the more trusted they will be by the institutions, I imagine. I guess the other part that we haven't spoken about at all really in terms of kind of boosting the digital asset market is central bank digital currencies. We've kind of come a long way from, when Bitcoin sparked all this off in 2009 to where we are now. Bitcoin was meant to be money without government, and now we've got governments talking about issuing their own digital currencies, and there's many, many projects around the world. So I just wanted to turn to Hugh just to touch on a little bit about how you think that CBDCs might help boost the wider digital asset market. Because again, it's a sort of a hybrid function of us being able to bridge between central banks, commercial banks, and what people are doing on, on a day-to-day basis as consumers.
Yeah, I think my answer will just, quite frankly, elegantly cross-sectionalize everybody else's comments here today, right? It's all down to trust and custody. If you take a step back and imagine a 100% Amazonian as an Amazon or eBay type view, where everybody finds the products, they do product discovery, price discovery, then counterparty discovery if they're really interested, and it's all settled and guaranteed, right? That's ultimately, I think, where we're going to end up, both for traditional instruments and digital instruments, which will replace in time the traditional instruments. And that's a vision, yeah. But that's 5 to 10 years away, right? Where we are right now is we have a wealth of, as discussed earlier, use cases, right? With crypto being a fantastic entrant for digital assets as a whole, of which stable coins, by each of the countries will fall into play. And we're still in the early stages, right? We have that wealth of use cases right now, and well done cryptocurrencies, because it's allowed us to prove things from a frictional point of view. But why wouldn't a sovereign nation create a optimized currency? Because that's really what it is at the end of the day. Forget the market. It's just an optimized currency where you don't have to print it, you don't have to clean it, literally clean it, sanitize it, issue it, recoup it, burn it. What a waste of money and time. So why wouldn't we actually move to digital currencies globally for fiat? And I think it all boils down to the markets warming up from the point of view of trust and custody. And that's actually really, really what's quite interesting. And you mentioned something in the introduction to the question, which is, well, we have a frictionless global set of currencies as it relates to cryptos, but those use cases that we're seeing there from a point of view regulatory and law and implementation and enforceability is absolutely key. But we don't want to throw the baby out with the bathwater and throw out all of the use cases of traditional settlement law and cases that have actually happened globally, the circuit breakers that actually come into play, that if we actually have to shut down a market in the US, for example, knowing when the music stops, where all the assets are, regardless of whether they're actually brought over from other countries, such as stocks through intermediators and agents, all of that needs to be replicated for us to fully move to a digital environment. It won't be, I will buy a stock in a UK company from the US, regardless of where it sits. I would reckon that in a digital world, a frictionless world, all of that will be digitized, but we'll still have many of the actors, and we'll still need local currency to be able to bring that to a close. So in short, I think the digital currencies, stable coins, sovereign, will actually drive the growth of our markets quite aggressively, so that we'll start to see, the moment they arrive, collateralization, the key element, the caboose, if you would, to be able to satisfy this, be it bonds, be it equity issues or other elements, and notably cash, for the custody and the collateralization, which will actually grow all of our digital assets. And as that starts to happen, then we'll start to see, like a metronome, the growth of all of our assets moving to digital. So it boils down to trust and custody around the collateralization of all of our markets, which I think is going to be sped up greatly the more we get stable coins coming to the market. Back to you.
So, I mean, that's, a very interesting prospect once we imagine all of that happening. What do you think are the next steps, Anoop, in terms of the two sides, both traditional finance and DeFi? What do you think they need to do to really bring together this kind of more frictionless interaction that he was describing?
I think it's a number of things. Definitely an acceleration of a digital transformation journey. We've kind of discussed, kind of the components of what that needs to look like. But I would also argue that, we also need a bit of self-regulation in this space, right? And so there have been attempts. If you look at the Chicago DeFi Alliance, right? It is a group of organizations that have come together to show that they are in fact looking to self-regulate, right, as good actors in this space. And so, I would argue that we need a multi-pronged approach, from self-regulation to better security practices, being preemptive. In some cases, actually in most cases, we need to be preemptive. We need to really understand the root of where a lot of the illicit fund movement actually occurs, right? Where does it start from before it hits a centralized or a decentralized exchange, right? And I think there are gaps in our understanding of that space, right? The two worlds of classical cybersecurity and CeFi DeFi haven't quite merged yet, right? So I think that's a significant opportunity. And then kind of go beyond that is how do we remove the friction so that anybody can really very quickly, in under 3 minutes or less, stand up an offering, test a market opportunity, and if they like the results, great, they can double down. If they don't, they can terminate that service, right? I think that's what, the opportunity of building hybrid infrastructure, hybrid capital markets infrastructure really unlocks. It's the ability to go into a new territory, a new region, and comply with, that region's requirements, regulations, run the experiment in a commercially viable way. And if you like the results, off you go, go make tons of money. If you don't like the results, no loss, no worries, all good. You can terminate. And so, being able to kind of get more granular around how do you identify risk and how do you measure that against the opportunity, and run that through a series of experiments. I mean, this is one of the things that we do really well here at AWS, and more broadly Amazon, is we experiment all the time. And I think it's that kind of mindset that I think we need to start developing more proactively in this space. So it's a number of things. It's not going to be just one, but I would say experimentation with real assets is going to be important.
Yeah, and we've certainly seen waves of innovation since the creation of the original cryptocurrency in Bitcoin. We've seen Ethereum come along with smart contracts. We've seen kind of the ICO boom and then the bust. We've seen kind of DeFi and NFTs and metaverse come along. So we're seeing kind of, multiple waves of innovation, and each one, as you say, by its nature has experimentation and failures. But I think the pace of change is speeding up.
Absolutely.
Hugh, when you look at this, what do you see in terms of a time horizon for where CeFi and DeFi really sort of interconnect? Is it 5 years, 10 years, 20 years? How do you see that kind of reaching a tipping point?
I think that the tipping point is, like Anoop said earlier, when 20% of trading activity, perhaps I'm paraphrasing, will be on digital assets. I think that's going to be the point of no return, if you would. Right, and I'm going to bet that that's going to happen in probably 3 years' time. Yep, the point where we're completely converted is probably 10 to 15 years' time. There's a lot of legacy and a lot of existing actors to replace, but I think the it's not quite a tipping point, but it's the first major foundational step. Will probably be in 3 years' time to get to 20%. That's one man's opinion.
I think that's very encouraging. Sadly, we're coming to the end of the time. I think it's been a really fascinating discussion. I wanted to just ask Hiranda just to make some closing remarks and tell us a little bit about what you've been working on with Multi-Hub, because I think that sort of encapsulates some of the themes that we've talked about today.
Yeah, thanks, Helen. I mean, a great discussion. I mean, to summarize, I mean, on the one hand, we're kind of concluding that APIs don't go away, but as Nicholas said, for multiple point-to-point connections, whether it's multiple custodians, there's APIs on the one hand. On the other hand, those custodians might be on different blockchains, so the capacity to run multiple nodes or types of nodes on the other hand. So I think we're definitely seeing the need for some form of orchestration layer that allows interoperability between TradFi and DeFi, and that can encapsulate some of the things that we've said, because on the decentralized side, a lot of the tools that institutions need, net asset value, reconciliations, other elements, all those tools don't necessarily exist on the decentralized side, but equally those are needed because they need to integrate into risk systems and other things that Anoop raised, just to allow that kind of seamless visibility of transaction flow and trading, clearing, and settlement. It's interesting when we talk about time horizons. I mean, we're seeing, like I said, over the last 12 months, we're seeing a shift. Some of the stuff that we were doing, we've been fortunate where we partnered with AWS and DXC Luxoft on Multi-Hub, which we foresaw a couple of years ago, this orchestration layer and the need to bridge between these two worlds. That we kind of, when we kind of talked about it conceptually, we got laughed at a couple of years ago, although Anoop was very interested and saw where things were going. Now we're beginning to see that play out, because the number of tier 1, tier 2 institutions we've engaged with recently that want access but want it in that packaged into a kind of centralized world is increasing. Ultimately, even if they move to decentralized technologies, they can't embrace all of them. and that network of networks is really, really important. So we're fortunate. We're working on something with DXC, Luxoft, and AWS called Multi-Hub, but that alone isn't the single solution. The ability to connect and collaborate, as Anoop said, with multiple solutions, because everyone's doing slightly different things here. There are other networks out there. There's traditional infrastructure that's been around for decades, and equally, there's new forms of technologies emerging. We're going to see all of these interoperate, integrate in whatever way, shape, or form they are. And this is really, really exciting, because it's going to lend itself to the tokenization opportunities that Nicola speaks about, increased distribution and ultimately increase revenues, but also do things a bit like AWS Cloud in a scalable way, where you don't have to spend tons and tons of money up front to experiment. You can do that, you can try things, and it becomes more of an OPEX driven model that aligns with your revenues, because gone are the days where you can spend millions of dollars of budget on something. The business side is going to be saying it's got to come out of somebody's P&L, right? It helps break that chicken and egg problem.
Yes, and I think, we can clearly see that the era of hybrid finance is here and it's growing. So unfortunately, we've come to the end of our time, but I'd just like to thank all of the speakers. Thank you to GMEX, AWS and Luxoft for putting this event together today. And thank you to all the attendees for joining us. If you do have further questions, I'm sure the panel will be happy to be contacted via their LinkedIn or Twitter or wherever they hang out on social media, and we'll be sending around this video afterwards as well. So if you have a colleague who missed it, then we'll be following up with a video so you can catch up later. So thanks so much for everyone for attending.
Or the metaverse, Helen,
forgot
that.
Find us in the metaverse. I don't think anyone's doing Clubhouse anymore, but you could try and find us there. Thanks so much.
Thank you, everybody.
Bye-bye.
Thank you, everyone.